All right, welcome to the Explainer. Today, we're going to break down a word you hear literally everywhere, from the news to the grocery store: inflation. We're going to spend the next few minutes unpacking what it is, where it comes from, and yeah, most importantly, what it means for your wallet.
You ever get that feeling like your money just doesn't stretch as far as it used to? You know that feeling when a $20 bill just seems to vanish at the checkout line? Well, you're not imagining it. That feeling, that's inflation.
Okay, so what exactly is this invisible force that seems to be shrinking our money? Let's dive right in and get to the bottom of it. So, in simple terms, inflation is just the gradual loss of your money's buying power. It means that every single dollar you have buys a little bit less of a good or a service than it did before. It's not about the price of, say, just gas going up, but the average price of pretty much everything across the whole economy. And this slide, wow, this really brings that long-term effect to life. Just think about this for a second. To buy the exact same stuff that $10,000 could get you back in 1975, today you'd need over $60,000. That's just how much our purchasing power has eroded over time. It's pretty incredible when you see it laid out like that. Okay, so how on earth do we measure this thing? Well, economists have a tool for that, and it's called the Consumer Price Index, or CPI for short. It's basically the go-to way to boil all these price changes down into one single, understandable number. So how does the CPI thing actually work? Well, imagine a giant shopping cart, a basket filled with all the stuff an average household buys. We're talking everything from food and gas to rent and even movie tickets. The CPI just tracks the total price of this basket over time. When the cost of the basket goes up, that's inflation.
All right, so that's the what. We get it. But what about the why? Why do prices go up in the first place? Let's take a look at the main causes.
Yeah, so economists usually point to two main drivers here, and you can really think of them as two sides of the same coin. First, you've got demand pull inflation. This is basically too much money chasing too few goods. Everybody wants to buy stuff, demand is super high, and that pulls prices up. Then on the other side, you have cost push inflation. This happens when it just costs more to make things. Maybe oil prices spike or something, and companies have no choice but to push those higher costs onto us, the consumers. And then there's this third type, which is kind of interesting because it's more psychological. It's called built-in inflation, and it's all about our expectations, right? So if everyone sinks, prices are going to go up, workers are going to demand higher wages to keep up. But then, to cover those higher wages, businesses have to raise their prices. See the loop? It becomes this self-fulfilling prophecy, what's often called the wage price spiral. But there's another really big theory out there, famously summed up by the economist Milton Friedman. He basically said that at its core, inflation is always about one thing: the money supply. It's a monetary phenomenon. In other words, it happens when the amount of money in an economy grows way faster than the actual stuff we can buy with it. Okay, now here's where things get a little weird. We always talk about inflation like it's this big, scary monster, right? But what if I told you it actually has a good side too? Yeah, economists kind of see it as having this dual personality. So yeah, the downsides are pretty obvious. It absolutely eats away at your savings, and it can be really tough for people on fixed incomes, like retirees. But, and this is a big but, a little bit of steady inflation is actually seen as a good thing for the economy. Why? Well, it encourages people and businesses to spend and invest their money rather than just stuffing it under a mattress where it's losing value. It keeps the whole economic engine humming. Plus, and this is a sneaky one, it's actually good for people with debt, like a mortgage, because it slowly reduces the real value of what they owe over time. But, of course, there's a flip side. What happens when inflation isn't this small, manageable thing? What happens when it breaks its leash and just spirals completely out of control? Well, that's when we see its truly ugly, destructive side. Yeah, we're talking about hyperinflation. And the definition for that is just nuts. It's typically when prices rise by more than 50%, not a year, a month. Can you even imagine that? Your grocery bill basically doubling every couple of months. It's chaos. And this isn't just theory. A classic real-world example is Germany's Weimar Republic after World War I. Inflation got so bad, so fast, that money became almost completely worthless. People literally had wheelbarrows full of cash just to buy a loaf of bread. They even used stacks of bills as wallpaper because it was cheaper than actual wallpaper. Just unbelievable. Okay, so whose job is it to make sure that kind of chaos doesn't happen? Who's taming this economic beast? Well, in most countries, that massive responsibility falls to the nation's central bank. Here in the US, that's the Federal Reserve, or the Fed, as you always hear. And their number one weapon against inflation is adjusting interest rates. Think of it like this. When they raise interest rates, it becomes more expensive for you to get a car loan or a mortgage, or for a business to borrow money to expand. That makes everyone slow down their spending. It's like the Fed is gently tapping the brakes on the whole economy to cool things down and let prices stabilize. So, this might sound counterintuitive, but the goal is actually not zero inflation. A world with zero inflation is really dangerous because you're just one step away from deflation. That's when prices start falling and the whole economy can just grind to a halt. So that's why central banks like the Fed aim for a sweet spot, a Goldilocks number, a low and stable inflation rate of around 2% per year. Okay, so let's bring this all back to you. The big question for all of us is, what can we actually do to protect our own finances when prices are climbing? All right, so what are some practical moves? First off, it's a great time to really take a hard look at your budget, see where the money's going and where you might be able to scale back. Second, since fighting inflation usually means higher interest rates, it might be smart to hold off on any big debt finance purchases like a new car if you can. And finally, you've got to think about your savings and investments. Some assets, like real estate or certain stocks, tend to hold their value or even do well during inflationary times. And there are even special government bonds called TIPS, which are literally designed to do one thing: protect your money from losing its value to inflation. And that brings us to a final, pretty interesting question to think about. We've established that the goal is a little bit of inflation, and we know that this system tends to help people who borrow money and hurt people who save it. So it really makes you wonder, who does this whole system really benefit most in the long run? We'll leave you with that one to ponder. Thanks for tuning into The Explainer.
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.